move, and we should be able to get done before it goes to end.
Shall we start?
I think, I don't know, another minute? Let's make it another, the clock.
Meeting will come to order. Good morning. Thank you. Good afternoon. Thank you. Appreciate you all coming today. This actually is the organizational meeting of the Select Revenue Measures Subcommittee for the 113th Congress. Try to keep this short so we can begin today's hearings and accommodate our witnesses' schedules. This meeting is open to the public. There will be an official transcript of the proceedings. First, I want to take a moment and say that I very much look forward to continuing my work with my friend Richie Neal for yet another Congress. This is the third consecutive Congress where Mr. Neal and I have served together as senior members of the subcommittee, and I commend him for 4 years of bipartisanship on this subcommittee and have no doubt that that spirit will continue over the next 2 years. And I really do appreciate his willingness to work with our side, both when he was in the majority as well as today. In the 113th Congress, this subcommittee will continue to play a central role in advancing comprehensive tax reform. I look forward to working with Mr. Neal on this important issue as well as others on both the Republican and Democratic side of the aisle. Mr. Neal, would you like to have a few words or an opening remarks?
Yes. Thank you, Mr. Chairman, and continue to be honored to serve as the ranking member of the subcommittee. Pat and I share the goal that this subcommittee should operate in the same bipartisan spirit as we did last Congress. You should know that Pat Tiberi and I actually talk to each other. We strive to have our witnesses represent diverse points of view and have representation of our members' input to the greatest extent possible. I was pleased to work with the subcommittee and the accomplishments of last Congress. We held a number of hearings on a wide variety of topics, with a general focus on tax reform, including harbor maintenance, funding, and maritime tax issues, foreign investment, energy tax provisions, and a review of expiring tax provisions. We play an important role in vetting issues for the full committee, and I look forward to continuing that role, beginning with our hearing today. One issue that I hope we can take up soon is always to increase savings for millions of Americans who don't have access to workplace plans, such as the auto IRA proposal that I have offered. And with that, I want to thank you, Mr. Chairman, for yielding.
Well, thank you. Richie and I not only talk to each other, but we like each other. And I've promised to root for the Celtics, who now have a young man who graduated from the same high school that I went to in Columbus, Jared Sullinger. If you promise to root for the Buckeyes in the tournament. No, I'm just kidding.
Not there yet.
I'd like to introduce the members on my right. Mr. Paulson of Minnesota. Mr. Schock of Illinois is on his way. Mr. Gerlach of Pennsylvania is here. Mr. Reed of New York. Mr. Young of Indiana. And I thought Mr. Marchant was here. He might be in the back. Of Texas, our members. And we all thank you for being part of this subcommittee. Mr. Neal, would you like to recognize the members on your left?
Thank you, Mr. Chairman. Let me introduce the Democratic Subcommittee members, my longtime pal John Larson of Connecticut, Allison Schwartz of Pennsylvania, a friend, and of course another friend, Linda Sanchez of California. And thank you again for yielding.
Thank you, Mr. Neal. I'd like to introduce our subcommittee staff, Mr. George Callis, Staff Director, and Mr. John Sandel, Legislative Assistant. Mr. Deal?
Let me introduce our subcommittee staff, and again, like the staff here that works at Ways and Means and Joint Tax, well known for their competence. Aruna Kailan, and of course my tax counsel, Kara Getz. Other members of the tax staff include Janice Mays, Mike Houseworth, Drew Croach, Karen McAfee, Alan Lee, and John Young. Thank you, Mr. Chairman, for yielding.
You are welcome. Anyone have a comment from the subcommittee? Questions? On a procedural note, as in past years, the subcommittee will operate under the same rules as the full committee with respect to hearings. The chairman and ranking member of their designee will each make an opening statement before we hear from our witnesses. Other members may submit written statements for the record. The chairman intends to require both witnesses and members to adhere to the 5-minute rule for testimony and questioning. If needed, we may proceed with the second round of questioning as well. On occasion, other members of the committee or other members not on the full committee may join us at a hearing. I look forward to working with all of you in the months ahead. As Chairman Camp has said, we plan to do comprehensive tax reform. With that, the organizational meeting stands adjourned. So, our second hearing.
You can go now.
Our second hearing will come to order. Good afternoon. Thank you for joining us for the subcommittee's first official hearing of the 113th Congress. I commend Chairman Camp for his continued efforts and leadership to overhaul our tax code, and we as a subcommittee, I speak for everyone, look forward to working with him and Ranking Member Levin to do that this session of Congress. Today, we examine the Financial Products Discussion Draft released by Chairman Camp and the Ways and Means Committee in January. The Financial Products Discussion Draft is a starting point for how the committee can modernize the taxation of financial products as part of comprehensive tax reform. Simplifying the taxation of financial products is long overdue. However, it should also be done in the context of broader legislation that would, amongst other things, lower statutory tax rates. Indeed, these changes would have a different impact on financial products if the draft was enacted as a one-off revenue raiser or tax increase, something that neither Chairman Camp nor I would support. The changes proposed in the discussion draft have received support from both sides of the aisle. I'm looking forward to a great bipartisan discussion today with our witnesses and members. I thank our witnesses for being here and now yield to Ranking Member Neal for his opening statement.
Thank you, Mr. Chairman, for calling this important hearing. As you know, the taxation of derivatives is an issue that I've worked on for many years. In fact, when I was chairman of the subcommittee, we held hearings on the tax treatment of derivatives and exchange-traded notes, or ETNs as they're known. We've also introduced legislation to address the tax treatment of exchange-traded notes. But going back even further, in 1998, following the collapse of long-term capital management and a federal bailout in the billions, I joined Barbara Kennelly in filing legislation to shut down the tax avoidance transactions set up through derivatives. With that experience, I can tell you that this topic is not for the faint of heart. Just explaining the different types of derivatives can fill volumes, plus the market is constantly evolving and growing. But this is an important area of our tax law and one that is in need of reform. So I applaud Chairman Camp for taking up the challenge and releasing a discussion draft that has had a lot of merit. Chairman Camp's legislation updates the antiquated tax treatment of financial derivatives and replaces it with a single set of rules. Under current law, you can have two types of derivatives that are economically similar but are taxed differently. The Camp proposal would eliminate this distinction by requiring investors to use mark-to-market for all derivatives, except for business hedging. And I think harmonizing those rules makes a lot of sense. Today we're going to hear from witnesses who will outline some of the technical issues with the bill. I've also heard from some of my insurance company constituents who may need us to amend the proposal to ensure that legitimate hedging transactions commonly used in the industry to insure against business risk do not get swept into the mark-to-market provisions of the bill. And I hope to work with Chairman Camp and Chairman Teaberry to address these issues. Let me conclude by saying this is an area where there is agreement between the parties on how to address a problem with our tax rules. I would also encourage my Republican friends to work with us on these proposals, and let's get it done. Thank you, Mr. Chairman.
Thank you. Before I introduce today's witnesses, I'd ask unanimous consent that all members' written statements will be included in the record. Without objection, so ordered. We now turn to our panel of distinguished witnesses. I'd like to welcome, and I'll introduce you all first, and we'll begin with Ms. Hammer. Ms. Viva Hammer of the Hadash Brandeis Institute at Brandeis University in Waltham, Massachusetts. Thank you for being here today. Second, Mr. Stephen Rosenthal, visiting fellow at the Tax Policy Center in Washington, D.C. Thank you. Third, Mr. David Garlock, Director of Financial Services at Ernst & Young National Tax here in Washington, D.C. Thank you. Fourth, Mr. William Paul, a partner at Covington & Burlington here in Washington, D.C. Thank you. And finally, Sean Travis, a principal in the Global Tax Department at the Vanguard Group in Valley Forge, Pennsylvania. Thank you for being here. With that, Ms. Hammer, you may begin. You have 5 minutes.
Chairman Teaberry, Honored Ranking Member Neal, and distinguished members of the subcommittee, I am here today to support the Ways and Means Committee's comprehensive tax reform and especially simplifying the taxation of financial transactions. For 22 years, I have practiced U.S. tax law, serving our government and all manner of taxpayers. But today, my constituents are my children, who sit behind me, and your children, who will live with the tax code far longer than we will. Derivatives are contracts agreed to between free parties, nimble and changing. Laws taxing derivatives are enacted after long contemplation by Congress and are rarely discarded. What happens when mostly fixed, ever-accumulating tax rules govern nimble, changing derivatives? The old tax system doesn't work for derivatives. Tax liability is measured once a year after realization events, and there is a sharp division between ordinary income and capital gains. Derivatives are flexible about when and how often payments are made, and they make a mockery of the antiquated divide between capital and ordinary assets. And derivative income can be easily realized or avoided. The tax law is always playing catch-up with the derivatives market, with lightning bolt fixes for transactions it doesn't like. The result is a jumble of rules. Clever people shape the rules to suit them, but for most Americans, the taxation of financial products is incomprehensible. When I talk to my clients about the laws for options, prepaid forwards, kinky forwards, future swaps, straddles, mixed straddles, wash sales, short sales, constructive sales, their jaws drop open and often do not close. Alternatively, they fall asleep. Taxes are necessary for civilized society, but civilized tax laws should intrude into society as little as possible. Good tax laws should be equitable. They should be efficient, they should be easy to understand and easy to administer. Today's jumble of derivatives laws fails all these principles. The Financial Products Tax Reform discussion draft is the beginning of a journey to simplify the taxation of derivatives, starting with mark-to-market. It will reduce advantages to the sophisticated as well as traps for the unwary. People worry about how to value derivatives when they are mark-to-market. But on that question, we ride together with the whole financial world. Mark-to-market is used for accounting, regulatory, risk management, credit, and compensation purposes. For most derivatives, valuation is clear. And for the complex and obscure ones that raise valuation questions, I guarantee you the current law doesn't know what to do with them either. We've had 30 years of experience with mark-to-market under Section 1256 and 20 years under 475, both with exchange-traded and non-exchange-traded derivatives. People complained about them before these sections were passed, but no one lobbies for their repeal today. Remember, mark-to-market means that taxpayers can take losses as well as gains, and many will welcome that. The discussion draft makes clear the character is as ordinary. This has advantages to corporations and disadvantages to individuals, and the biggest benefit is simplicity. The discussion draft has a new approach for taxpayers that have derivatives linked to other assets and liabilities it owns. Today, there are too many regimes to govern this, and Congress needs to bring it all under one umbrella, perhaps by offering an election for taxpayers to mark all their positions to market, a solution that I would suggest for your clients, Mr. Neal, both derivative and non-derivative, pre- and post-effective.
Could I just offer a thought? They're my constituents. I'm not in that market.
Okay. Like my children are my constituents, but I need more time now. So, an election, everyone loves an election. Investments that wrap derivatives into one package with non-derivatives, called hybrids, like, for example, convertible bonds, will be difficult to tackle in the modern world. But don't let hybrids kill mark-to-market. Cut them out if you need to. The discussion draft has no rule about withholding on derivatives, and I was very disappointed about that. I hope as Congress moves forward with reform, it develops comprehensive rules on withholding, not anti-abuse rules, robust, substantive rules. People will fret about the change in the taxation of derivatives, but be not dismayed by the naysayers. Change is painful, even change for the greater good. Who was in favor of the income tax when it was first imposed? And yet we live with it still, changing it as it changes us. Mark-to-market is a change whose time has come. Thank you.
Thank you. May I just ask one question? Is that a Boston accent or a Springfield accent?
Am I under oath here? It's a deep South, very deep South.
South Boston. Mr. Larson contends it's South Boston. Mr. Rosenthal, you're recognized for 5 minutes.
Thank you. Chairman Teaberry, Member Neal, and members of the committee. My name is Steve Rosenthal, and I am a visiting fellow at the Tax Policy Center. I have practiced tax law in D.C. for over 25 years, both in private practice and for the Joint Committee on Taxation in the 1990s. Thank you for allowing me to share my views on the proposed tax reforms for financial products. I applaud the bold steps in the discussion draft. The discussion draft simplifies the many choices that now confront taxpayers. In my view, our tax rules accommodate too many choices for too many special interests. There are many constituencies for every provision in the code, but there are few constituencies for simplification. I am pleased to see the committee pursue that less traveled road. I want to highlight 3 suggestions from my written testimony, which I believe will further the committee's goals. First, I wholeheartedly endorse, as has Ms. Hammer, the mark-to-market method of accounting for derivatives. A mark-to-market method of accounting would tax each derivative as if it were sold at the end of the year and gains and losses recognized accordingly. A uniform approach to taxing derivatives has long been the holy grail of tax policy for financial products. The committee is almost there, and I believe the committee can get there with just a little help on the valuation of derivatives, which, as Ms. Hammer observed, is the key to a success of a mark-to-market method of accounting. To help, I believe the committee should require swap dealers to share their valuations of derivatives with their customers. That will help customers value these derivatives for purposes of the customer's tax returns. Swap dealers already mark-to-market all of their derivatives for their own tax returns under Code Section 475. And under the recent Dodd-Frank legislation, swap dealers already must share the values of many of their derivatives with their customers to improve transparency. Next, I agree that investors should use a single basis method to calculate their stock gains and losses. The discussion draft would repeal FIFO specific identification and other methods and require the average cost method. Currently, brokers must ask their customers to choose a method in order for the broker to report the customer's basis correctly, which customers use to calculate their gains and losses. I agree that we should allow only one choice and eliminate the current menu. I have a small suggestion, though. I think we should shift to the use of FIFO as that single basis choice rather than average cost. I believe FIFO would be simpler for investors to understand and to use. Finally, I understand the desire for a related party role for wash sale losses. A wash sale loss arises when a taxpayer sells stock at a loss and requires substantially identical stock within 30 days. Technically, a taxpayer could avoid the wash sale rules by selling stock at a loss and arranging for a related party to the taxpayer rather than the taxpayer itself to repurchase the stock. The discussion draft extends the wash sale rules to reacquisitions by related parties, such as spouses or IRAs. However, unlike present law, a wash sale loss that resulted from a reacquisition by a related party would be permanently disallowed, not merely temporarily disallowed. I believe a permanent disallowance creates a trap for the unsuspecting, and I suggest that we merely suspend the loss for the original seller, and when the related party sells the position again, resells the stock again, we free up the loss for the original seller. I think that would accomplish the closing of the loopholes that the committee anticipates, but provides and furthers the tax policy of the wash sale rules. Thank you.
Thank you, sir. Mr. Garlock. Garlock, you're recognized for 5 minutes.
Thank you, Mr. Chairman, members of the subcommittee. Good afternoon. As Chairman Tiberi mentioned, I'm a principal in the National Tax Department of Ernst & Young, and I'm based here in Washington, D.C. My practice is devoted almost entirely to the taxation of financial instruments with a particular focus on the taxation of debt. I'm testifying today on my own behalf and not on behalf of Ernst & Young or any of its clients. My focus is somewhat different from that of the other panelists. The discussion draft includes 4 provisions relating to the taxation of debt instruments. 2 are relatively minor provisions, and I won't discuss those today, but I will discuss the other 2 provisions briefly. The other 2 provisions dealing with debt instruments in the discussion draft are designed to address problems under current law with the tax treatment of so-called distressed debt. That phrase refers to debt that's owned by a borrower that's having financial difficulties, so there is a serious risk that the borrower will not be able to pay the full amount that's owed on the debt. Both of these provisions are drawn from a report of the American Bar Association Tax Section Committee on Financial Instruments submitted to Congress in December 2011. I was one of the co-authors of that report, as are several of the other panelists, and had significant responsibilities, so it's not surprising that I will be supportive of some of the provisions in the discussion draft. The first major debt-related provision in the discussion draft deals with the consequences of a debt modification. And generally, this provision prevents a borrower from having taxable income from the cancellation of indebtedness when its debt is modified merely because it's publicly trading at a discount. Now, Congress provided a temporary fix to this problem in 2009 with the enactment of Code Section 108I, but that provision expired at the end of 2010. I believe the discussion's drafts provides a better approach to this problem than Section 108I and should be enacted. The discussion draft does not unfortunately address a corresponding problem for investors in distressed debt, and I believe that companion provision, which was included in the ABA report to address this problem, should be added to legislation as it moves forward. Briefly, that suggested rule would conform the treatment of all debt modifications and exchanges to the treatment accorded to exchanges involving corporate securities. That is, in most all cases, no gain or loss would be recognized at the time of the exchange, and the investor's basis would carry over to the new debt. The second of the 2 major debt provisions addresses the treatment of market discount. Market discount arises when debt changes hands in the secondary market at a price that is lower than the debt's face amount. Now, market discount can arise either because prevailing interest rates have risen since the debt was issued, or because the borrower is in financial distress, or some combination of the two. As a general matter, the problem with current laws governing market discount is that they do not distinguish between the two potential sources of market discount. The provisions in the code governing the taxation of debt were enacted mostly in 1982 and 1984, and at that time, prevailing interest rates were at historic highs rather than the current historic lows. When interest rates are high, notes, bonds, and other debt instruments trade at significant discounts, having nothing to do with the financial distress. And accordingly, the rules governing debt trading at a discount were written based on the implicit assumption that discount was attributable exclusively to high interest rates. As a staff person at the time, I can assume my share of responsibility for that default in the rules. Accordingly, the rules governing debt trading, in the current interest rate environment, essentially the opposite is true, making the current rules governing the taxation of debt particularly in need of refinement. The discussion draft would address this problem by placing a cap on the rate at which market discount accrues, which is designed to differentiate between discount arising from higher interest rates and financial distress. I think this would be a significant step in the right direction, and I support its enactment. Another aspect of the discussion draft would require taxpayers to include market discount in income as it accrues, subject to the yield cap. Under current law, this is elective. I feel that there's considerable merit to this proposed rule as well, but I think it requires further discussion and analysis, as I explain in my written submission. In brief, the principal concern I raise is that even with a yield cap, not all market discount is an interest equivalent that should accrue and be includable in income based on yield to maturity concepts. I appreciate the opportunity to appear before the subcommittee. I hope my input has been helpful. Thank you.
Yes, it has. Thank you, Mr. Paul. You're recognized for 5 minutes.
Thank you. Mr. Chairman, Ranking Member Neal, members of the committee. My name is William Paul. I'm a partner with the law firm of Covington & Burling, LLP. Thank you for inviting me here today to testify on Chairman Camp's draft proposals for financial products tax reform. I appear before you today on my own behalf. Although I represent clients that have an interest in the draft proposals, I am not representing them here today. My testimony should not be construed as reflecting their views or those of my law firm or any other organization with which I am affiliated. As a preliminary matter, I would like to add my voice to the chorus of praise that Chairman Camp has received for the open and transparent process he is following in developing comprehensive tax reform legislation. I also applaud the committee for holding this hearing today as part of the effort to receive input on the draft proposals in an open and public manner. My testimony today will focus on technical and practical issues raised by the draft proposal to adopt a uniform approach to the taxation of derivatives. The draft proposal would require that all derivatives be marked to market, that is, treated as sold on the last day of the taxable year. All gain or loss on derivatives would be treated as ordinary income or loss. The definition of derivative in the draft proposal is very broad. This definition may sweep in a variety of situations that are not intended to be covered. Examples include securities loans under Section 1058, American depository receipts, which represent beneficial ownership of stock issued by foreign corporations, employee stock options and other stock-based compensation, and variable annuities. It would probably be helpful if a list of instruments or interests that are not intended to be covered were added to the legislative language. The broad definition of derivatives include derivatives embedded in instruments treated as debt for tax purposes, such as the conversion feature in convertible debt instruments. The definition does not include derivatives embedded in other instruments, such as stock, and often there's a conversion feature in preferred stock, and it's referred to as convertible preferred stock. It also does not apply to embedded derivatives in partnership interest, and that's common in a structure known as an UPREIT structure. It is unclear if these omissions are intended, but I recommend they be addressed. The draft proposal would not apply mark-to-market ordinary treatment to direct ownership of stock, bonds, or commodities. This conclusion is understandable. However, it will mean that the goal of uniform treatment for economically similar positions will not be achieved in significant respects. To take the most obvious example, direct ownership of stock will be taxed differently from synthetic ownership of stock through a combination of derivatives, such as a forward contract to purchase stock coupled with a zero-coupon bond. This difference of tax treatment will result in clientele effects, as taxpayers who want ordinary income or loss treatment will use synthetic stock, and taxpayers preferring capital gain or loss treatment will own stock directly. The exclusion of stocks and bonds also raises questions about how to deal with transactions that in form are not derivatives but are economically equivalent to derivatives. For example, an equity swap is economically equivalent to a fully leveraged stock purchase. If A lends B $1,000, which B uses to buy stock from A, the cash flows are essentially the same as if A and B entered into an equity swap. Similar issues arise with regard to non-recourse debt. For example, if A's loan to B is non-recourse, B has the equivalent of long stock and a put option. As yet another example, consider a two-person partnership that holds dividend-paying stock. The partnership allocates the dividend income to one partner and gain or loss in the stock to the other partner. Treasury regulations make clear that such allocations may be permitted under current law. On these facts, the partnership interests and other partnership interests that slice and dice economic returns from stock, bonds, and other underliers can be viewed as very similar to derivatives. Rather than leave open the question of whether such economically equivalent positions should be taxed as derivatives, it would be helpful if the legislation addressed this question directly. The final issue I wish to raise today relates to valuation. The draft proposal is not limited to publicly traded derivatives or to derivatives with respect to which underlying property is publicly traded. It is not clear how the parties will determine fair market value or how the IRS will efficiently and effectively audit the valuations the party comes up with. In this regard, it is worth noting that in the 1990s, the IRS attempted to develop software to assist it in valuing derivatives. The effort was known as the Los Alamos Project because nuclear physicists at Los Alamos laboratories were engaged to assist in the effort. The project went on for several years but ultimately failed. This is not to say that a similar effort would necessarily fail again, but it is critical that the IRS be consulted to determine the extent to which a broad mark-to-market approach to derivatives will be administrable. In closing, I would refer the committee to my written testimony, which elaborates on the points I have made here today. Thank you, and I would be happy to respond to questions.
Thank you, Mr. Paul. Mr. Travis, you're recognized for 5 minutes.
Chairman Teaberry, Ranking Member Neal, and distinguished members of the subcommittee. I am a principal and senior counsel at Vanguard and want to start by conveying how grateful Vanguard is to appear today. We approach the discussion draft from a distinctive business perspective. We are one of the largest mutual fund complexes, managing more than $2.1 trillion in roughly 180 U.S. mutual funds and serving about 25 million shareholder accounts. We are also the only mutually owned mutual fund company. The funds we manage own Vanguard, giving us a singular purpose to provide our fund shareholders the best chance for long-term investment success. In pursuing our mission, we do use plain vanilla derivatives in managing our funds, primarily swaps, currency forwards, and futures contracts. These derivatives help our funds reduce transaction costs, construct portfolios more efficiently, and accommodate large cash flows with minimal disruption to fund long-term investment strategies. At the same time, we don't find much alignment between our client-focused approach and current derivatives tax law. We encourage our clients to take a straightforward approach to investing, to stay the course over the long term, and to expect plain talk about capital markets. By contrast, the derivatives tax laws are complex, elective in outcome, and not easily explained to our clients. We spend more resources than we would like keeping up with this complex tax regime, avoiding its pitfalls, and ensuring our systems comply. And we find it curious and discomforting that this regime allows taxpayers to elect their tax treatment, that economically similar derivatives can result in, alternatively, long-term capital gain, a mixture of long-term and short-term capital gain, or ordinary income. We believe we should compete on how effectively we manage our funds and serve our clients rather than how creative we can be with the tax laws. We are therefore encouraged that the discussion draft aims to take tax largely out of the investment decision, at least with respect to derivatives, and it reflects our belief that the code should provide clear rules that apply uniformly and give businesses like ours a durable regime we can easily comply with. We do, though, want to provide a few remarks on the mark-to-market and average cost basis proposals in the draft. First, mutual funds mark their derivatives to market daily for risk management and fund valuation purposes. Marking them to market for tax purposes should be a manageable extension of what funds already do. Second, we know many worry that marking to market leaves people without cash to pay tax, but we have not yet seen this concern play out in actual investor behavior. The vast majority of retail fund shareholders across the industry elect to reinvest their dividends, allowing them to grow their savings over time, but requiring them to pay current tax without cash. Though perspectives may differ, ours leads us to believe that people buying retail derivatives would similarly pay tax from other sources. While supporting mark-to-market as a framework for taxing derivatives, we do recommend further discussion in a couple of areas. First, taxing derivatives as ordinary income may create mismatches in our portfolios where the stocks and bonds are primarily or entirely capital assets. Secondly, expanding the definition of tax hedge to include investment assets may be more straightforward than revising the already complex straddle rules. This would allow derivatives to match the timing and character of the bonds and stocks they offset, as opposed to requiring the bonds and stocks to match the character and timing of the derivatives. As for the average cost basis proposal, we commend your effort to simplify these rules, and we note that the overwhelming majority of our fund shareholders use average cost for their mutual fund shares. But we do recommend further discussion in a few areas, including eliminating specific ID would mark a significant change for brokerage clients in particular and would have operational and economic consequences for mutual funds. Calculating average cost at the account level rather than the taxpayer level may dilute the impact of the proposal. Investors could presumably open multiple accounts, perhaps at multiple brokers, to recreate tax lot flexibility. Finally, firms in the industry have just built systems to report cost basis to investors as required by recent changes in law. It may surprise you to learn how expensive doing so was. We alone spent tens of millions of dollars. But these new systems do not report average cost for stocks and bonds because doing so was not previously allowed. Adding this functionality now would involve considerable additional cost that we ask Congress to weigh in evaluating any new approach. I would be happy to take any questions you may have.
Thank you, Mr. Travis. I'm going to begin with you and then ask each of you to comment on this, if I may. It appears each of you in your testimony, written testimony, believe that current tax rules haven't kept up with the innovation within the financial services product lines. Can you expand, Mr. Travis, a little bit deeper on suggestions that you have to us as to how we can be helpful?
What would be most helpful to us as a business is having a set of rules that apply uniformly across all products, all derivative products. We're not faced with multiple regimes where a new product comes up, it fits in one of these aspects of our derivatives tax regime, maybe not in another, or maybe it provides a benefit that becomes a tax benefit that becomes attractive without regard to the investment merits or other aspects of the product. We've previously commented on exchange-traded notes, and we're concerned about the credit risk that investors in those products take without any compensation for doing so. And the driver there, we think, is primarily the favorable tax treatment.
Mr. Paul?
Well, I would start by saying that there's a reason why the tax law hasn't kept up with financial product innovation, and I'm not sure there's a good answer to your question. There are various approaches people can take. One is the uniform approach that the draft proposals take. Another is to focus on derivatives or financial instruments that have the same economics, and at least try to get those taxed the same way so that people can't pick and choose a particular product based on the tax treatment they want to receive when there are other products with the same economics that are being treated otherwise. It's also been proposed that the system could be protected adequately as long as balance is applied, so that gains and losses on a particular type of product are treated evenly, and therefore the fisc can't be whipsawed. I would merely say there are various approaches. None of them is easy.
Thank you. Mr. Garlick.
I would say in general, I think that the Internal Revenue Code could be improved by more reliance on general principles and less reliance on specific rules. So I think that, for example, the mark-to-market proposal is a good example of a proposal or of a principle of general applicability, whereas if you start having specific rules for options, forwards, and so on, you're almost doomed to have a system that can't keep up with the market. So I think the mark-to-market proposal is a good example of moving in the direction of a general principle rather than specific rules.
Thank you. Mr. Rosenthal.
Yes, Chairman Tiberi, I agree that our tax laws have not kept up with the markets. Our tax laws date back to the early 1900s. We have arcane notions of realization, that is, you don't pay a tax until you actually sell something. But unfortunately, information technology, financial engineers have outpaced those notions. And so now, rather than, say, drill a well to strive for tax benefits, you just add a few zeros to pieces of paper to carefully designed structures. I think the answer is actually the answer that's in Chairman Camp's proposal. That is, can we mark-to-market derivatives and arrive at the holy grail of uniform taxation of these instruments? I think it would solve problems across the board in terms of the complexity and the manipulation of these products. The key, though, to the valuation, the key, though, to a mark-to-market method of accounting is valuation. When I was at the Joint Committee on Taxation staff, we worked for several years on how to think about requiring securities dealers to mark-to-market their derivatives, and we settled on an approach that I think has been robust over the last 20 years and has worked. And I think, again, the key is valuation. We've had so much benefit from the accountants. Financial accounting over the last 20 years now has FAS 133, and by and large, almost every derivative is mark-to-market. And Dodd-Frank also requires mark-to-market and for collateral purposes and offers a lot more transparency that we never had before.
Thank you. Ms. Hammer.
Being an academic, I'm going to give an answer that nobody's going to like, which is we need more law and more often. Today, mark-to-market is the right thing to do. Tomorrow, it's going to be something else. And you guys can't just sit around and wait for things to change. You need to rethink the laws on a regular basis. As several members have said here, my colleagues have said, we've got laws here that have been around for 100 years. What else has been around for 100 years? So I think that the question isn't what's the right answer today. The question is how to get the methods for making laws more liquid, more nimble, just like the people who do the derivatives. Every day they're sitting down thinking, what can we do today? How can we make something more marketable, more creative? I'd love to sit down every day with the committee and say, what can we do today that's more marketable? Now, the other thing that I want to say is Treasury needs to be more nimble as well. I was at Treasury. Everyone's nervous as anything to come out with a law just in case it's wrong. So I said, okay, it's wrong. Do it again. So I think that people are very nervous when they're making laws about doing the wrong thing, but if they redid them on a regular basis, they wouldn't be so nervous about it. So I told
Thank you.
I told you wouldn't like it.
I'll let you go a little longer since the guy who's been around here for a long number of years interrupted you earlier. Speaking of the guy who's been around here a long number of years, I will yield to him.
Thank you, Mr. Chairman. In 2007, I introduced legislation to address the tax treatment of exchange-traded notes, or ETNs. Although ETNs are issued by banks in the form of a debt instrument, they are not treated as debt for tax purposes. Instead, investors are told that these ETNs will defer tax on investment income earned all along the way for as long as 30 years. And then all of that income will turn into a long-term capital gain. One concern about ETNs is that their current tax treatment leads people to invest in them without fully appreciating the credit risks involved. In particular, the bank issuing the ETN may not be around when the ETN matures many years in the future. This point was brought home to us when Lehman Brothers declared bankruptcy and its ETNs became worthless. The ETN market has shrunk somewhat since the Lehman bankruptcy and financial crisis, but it's expanding again despite credit risk. In fact, the amount invested in ETNs has more than tripled in the past 5 years to $17 billion. Their current tax treatment is not the result of any legislation by Congress, but instead results from a gap in the tax law. My bill intended to fill that gap I'm pleased that Chairman Camp's legislation would require ETN holders to determine the product's value each year and pay taxes at ordinary income rates on any change, even if they haven't sold the securities. Mr. Travis, do you agree that the current gap in our tax laws make ETNs more attractive to investors, notwithstanding the credit risks involved? And do you think policymakers should fill this gap similar to the approach taken by myself and Dave Camp? And do any of the other witnesses have comments, and you're invited to offer them?
Mr. Neal, thank you. We are concerned that retail investors are buying ETNs in part because of the tax benefits under current law. There's also credit risk that they take. The troubling thing about the credit risk they're taking is that it's not compensated. They're not receiving any return for taking that risk as they would if they were buying a bond issued by the same bank. So this is terrific for the banks. They get cheap capital, inexpensive capital, but it's at the price of retail investors taking this uncompensated risk. So we are very concerned. We share your concern there. And we do think that Chairman Camp's approach, mark-to-market, would address the issue. We also thought your interest accrual was another way of addressing it as well. Thank you.
Mr. Rosenthal?
I agree with Mr. Travis. Exchange-traded notes are just one variant of the way derivatives can be used to manage tax liability. The note simply is wrapped around another strategy. Perhaps the strategy would have thrown off short-term capital gains that would be expensive in the near term. An exchange-traded note pays off over a year away and converts that short-term gain into long-term gain and defers that gain. Your approach in 2007 was a solid approach to require current accrual in these circumstances. I also favor Chairman Camp's approach, which I think goes beyond just the problems of exchange-traded notes to a wider range of derivatives. But yes, I agree that problem should be addressed in a comprehensive fashion.
I'm surprised you have an opinion on this, Ms. Hammer.
The problem of exchange-traded notes is one of a myriad of problems we have on instruments with multiple characteristics. And even if we adopt the most radical version of Chairman Camp's proposal, we are still going to have the issue of legacy laws. And I don't think anyone, and I shouldn't speak on myself, is going to suggest that we change the law for stocks and bonds completely. So the issue of what I call hybrids or mixed character instruments are going to be with us for a long time until we're ready to make radical moves.
Okay. And Mr. Travis, you stated in your testimony with respect to the mark-to-market proposal that taxing derivatives as ordinary income may create mismatches with existing treatment of stocks and bonds in your portfolios. I'm hearing the same point of view from many of my Massachusetts Mutual Fund constituents as well. Can you expand on this point? Explain to the committee what you would recommend doing instead, and the other witnesses will be given an opportunity as well.
Thank you, Mr. Neal. While we can support the mark-to-market approach as a framework for taxing derivatives, we are concerned with potential mismatches that could be created in our investment portfolios. Timing and character on the mark-to-market of the derivatives will not match the timing and character of the capital assets we hold in the fund, stocks and bonds. We think there are a couple of easy fixes. We think that consideration could be given to whether the mark on the derivative should be short-term capital gain instead of ordinary income. There may be pros and cons there. We could also think about the hedge accounting rules and perhaps extend those to investment assets so that when our portfolio managers are viewing a portfolio as a whole and adjusting the financial properties of it through use of a derivative, that the taxation of the derivative will follow the taxation of the thing that's being adjusted, the stock or the bonds.
We can take one more comment from anybody. Go ahead. Is there anybody else who would like to comment on that?
Well, this is an issue, and this issue of mixed character will be addressed, I believe, by the ABA report that we are going to submit later in a different format. I would say, though, I think the solution that Mr. Travis outlined second is better. That is to try to create a regime in which you match the character of a derivative with the offsetting position. We currently have such a regime to match derivatives against ordinary income and ordinary expenses, and that works very effectively. I suggest that we look to how we can extend that regime to match derivatives to hedge capital assets. And I think if we undertook that approach, we would solve a lot of these problems. There still is a tension sometimes in tracing between a derivative and the hedged position to determine whether it's matching the ordinary income or asset or a capital asset or not. I know Mr. Garlock, for instance, has worked on that issue for years and years. I think we could address that issue at least sufficiently to put ourselves in a better spot than we are today through a variety of upfront identifications and drafting approaches.
Thank you.
Thank you. Thank you, Mr. Chairman.
Mr. Paulson is recognized for 5 minutes.
Thank you, Mr. Chairman. Obviously, a very complicated area of the tax code, and I remember having our hearing with jointly with the Senate, actually, just a year and a half ago, and I remember learning there are definitely some areas of the code that are being abused for tax purposes, for instance, which is the goal of the draft, to kind of narrow down and zero in on some of those areas. I do have a question, because there's a couple of basic principles of the draft, and one is that it's to avoid burdening average retail investors, for instance, as much as possible. So stocks and bonds aren't covered under the draft, for instance. And secondly, another basic principle in general is distinguishing between financial transactions, which are covered by the draft, and then common business transactions, which would not be covered under the draft. So we'll just go down the panel line, but from your perspective, are there other kinds of transactions that are covered by the draft that common average investors should be excluded from under this principle? I mean, are we missing anything here? Mr. Travis?
Nothing comes to mind right now.
Okay. Mr. Paul?
Well, I think if you're talking about excluding, let me just say first, I do think that the definition of derivatives in the bill is broad enough that it will affect some transactions that so-called retail investors use frequently. I think the best examples are exchange-traded options, and investors who hold stock and are nervous about the stock market going down may buy a put option to protect their position. It's a form of hedging. In the business context, it would be perfectly fine. Here, it causes problems. Another is investors who own stock, including retail investors, frequently write call options on their stock called covered calls in order to generate additional income on their stock positions. Under the draft proposals, buying a protective put option or writing covered calls would pull you into these rules. And not only would the option be marked to market and treated as ordinary income or loss, but the stock that you hold would be marked to market. And you'd have ordinary income and loss on your stock while you had the option outstanding. I think convertible bonds may be another example where regular investors, not just wealthy investors, hold those. And under the proposal, the conversion feature, the embedded option to convert the debt into stock of the issuer, would have to be separately valued and then marked to market each year with the gain being reported currently as ordinary income or loss.
Good. Okay. Mr. Garlock?
I'm not aware of common business transactions that need to be excluded. I would generally agree with Mr. Paul that I think that it is appropriate to have derivatives in general that pertain to stock, securities, and commodities and so on generally be subject to mark-to-market rules. And although it may filter down to a fairly low level of the retail investment market, I think that if an investor is investing in those kinds of derivatives, they should be prepared to deal with the tax consequences that come in with mark-to-market.
Mr. Rosenthal?
Yes, Congressman Paulson, I think there will be some common business transactions that might yet be inadvertently swept into this provision. And I think the mark-to-market provision, and I think that we ought to be very mindful of that to try to restrict ourselves to financial and not normal business transactions. This problem was addressed by our brethren in the financial accounting community, the accountants, when they promulgated FAS 133 that required reporting mark-to-market accounting for derivatives. They excluded from their definition of a derivative what they labeled either normal or common business transactions, which included things like the forward delivery or receipt of commodities, and those were excluded in many circumstances. I think the approach of trying to exclude common business transactions is sensible, but more importantly, I think we should look to what the accountants have already done in terms of pioneering this approach for us. FAS 133 has been in place now for 15 years with really good experience, and I would start there to try to sensibly tackle what's in and what should not be in a mark-to-market for tax purposes. Added advantage is if it's marked for book, that eases the administrative burdens that you highlighted earlier. And so I think, again, there's all sorts of value to tapping into what our colleagues, either the regulators or the accountants, have been up to over the last several years.
Good. Ms. Hammer?
Thank you, Mr. Paulson. You ask a very complicated question, because I think the concept of retail investor, or I think that's a term you used, I don't even know what that means. I mean, the average grandmother, what are they doing in the derivatives market? So maybe you could say convertible bonds, but I'm going to suggest to you that the average retail grandmother who's in the market is there because there are perhaps unusual tax advantages. And you have to ask why they have unusual tax advantages. That's the first thing. The second thing is the current system so good that we should be retaining it when we've got something that's been suggested that has theoretical reasoning behind it? So the first question is, why is the current system good? And why isn't the new system, which has theoretical basis, better? So I think that there's a lot in your question that probably needs to be teased out. Thank you.
Yield back. Thank you. Mr. Gerlach is recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you all for testifying today. When I was in the state Senate in Pennsylvania and we get a complex piece of legislation in front of us, I'd always turn to a colleague of mine from Lancaster County and I'd ask him, why should we vote for this? And he'd say, because it does good. And what I'm hearing from you all is that you think the discussion draft does good, even though it's a very complex area of tax law and something from a layperson's standpoint is hard to get your head around. But from your perspective, you clearly indicate that this does good and something we should certainly consider. Can you give me each a macro kind of response to just the basic question as to if this legislation were be enacted, what would be the real-world impact ultimately on your clients' returns on investment, and what would be the impact, you think, on our general economy if we were to change this area of the tax law and your clients would move forward with the use of that tax law in terms of their investments? And we can start, Ms. Hammer, and we'll work down the line.
Thank you. I think that to generalize on the impact on taxpayers would be almost impossible, although you have economists, no doubt, who can do that. But you've got corporations, you've got pass-throughs, you've got individuals, you've got foreigners. I mean, I don't know that I could honestly tell you what the impact would be. I think the most important impact, though, is it would cost less to find out what the tax law is than to actually pay the tax. That would be a good result of this. A simplification to be the extent that the inquiry wouldn't take 6 hours and it was a half an hour to pay the tax. So that would be a benefit, I would think.
Great. Thank you. Mr. Rosenthal?
I think the broad impact would be rather modest, but narrow niches would be affected. The market for structured financial products on Wall Street, I think, would be curtailed to a great extent. The services that all of us have provided while we've been in private practice to unravel these complicated tax issues for derivatives, I think also would be diminished, probably to the benefit of the economy overall. And I would say one last point, which is when I worked on the staff to help the Congress develop Code Section 475, the mark-to-market for securities dealers, that legislation was passed 3 times before the President signed it into law, not because of any controversy of the legislation, but because there was other provisions, and the provisions were vetoed and the like. But every time that legislation was taken up by the House or by the Senate or in conference, we improved that legislation because the problem was so difficult. And likewise, as you extend mark-to-market more broadly, this problem is so difficult, it'll take a fair amount of effort to get through, but it does good.
Thank you. Mr. Garlock, I'm sure we're connected somewhere along the family tree.
6th cousins, something like that. So anyway,
17 times removed, but I'm sure connected. Go ahead. I'm sorry.
I'm going to confine my response to the debt provisions because that's my particular focus. I would generally agree with Mr. Rosenthal that I don't think it's going to have a huge impact. I would say in general, I believe the debt provisions will bring taxpayers' taxable income closer to their true economic income. And I think that's generally an improvement in the tax code when taxable income is closer to economic income. So I think they would be better in that respect.
Thank you. Mr. Paul?
Thank you. I guess I would just preface my response by saying the legislation is a discussion draft, so when one talks about what would the impact be if it were enacted, there are a lot of glitches there, and so you have to make some assumptions about it getting cleaned up as the legislative process moves forward. But if its main features are retained, and you ask how my clients particularly would be affected, the main thing I see is the treatment of exchange-traded options, because, as I mentioned, they are used by retail investors, and this would dramatically accelerate the tax and increase the tax for people who use those options.
Mm-hmm. Great, thank you. Mr. Travis?
Thank you, Mr. Gerlach. I think the mark-to-market proposal, if enacted, would bring much more certainty to the tax treatment of the derivatives in our portfolios. We take a lot of time researching what the law is, what different guidance may mean or may not mean for a particular transaction, understanding new instruments that are suggested to us, and taking a position on them. It's an involved, lengthy effort to ensure that we are complying, if not with guidance, because it's not there, at least with the spirit of the other guidance that we do have. And I think a lot of that effort would fall to the side, and we would know for certain going forward what the correct treatment of this transaction or this derivative is. That would be a huge benefit to us as a business. We could spend more time focusing on serving our clients and less time researching and documenting the positions we take.
Great. Thank you. Thank you. Thank you all for testifying, and yield back.
Mr. Larson is recognized for 5 minutes.
Thank you very much, Mr. Chairman, and I want to commend the chairman and Mr. Neal for this opening session and hearing. I'd also like to commend Chairman Camp as well for not only his work in this particular area, but designating the committee to work on select issues. And I want to acknowledge the efforts of Mr. Smith and Mr. Schock, who we've been working with in the area of financial services. Of course, my colleague, Mr. Neal, who since the time I came to Congress, he's not quite that old, Mr. Tiberi, but he has led the way with tax simplification and has worked very closely as well with Mr. Camp on the matters that we have before us. In this capacity, one of the things that we've done is spend a lot of time with the Joint Tax Committee. And in the process of what I think all of you have acknowledged, and certainly the members here have, what is a complicated area. And part of it is not only just demystification of the terminology that's out there, but also the unintended consequences. And so my question may be a little bit more specific, but one of the things that came up at Joint Tax is the further we peeled away the veneer of what Mr. Paul has already recognized as a draft proposal, was that in abiding to the principles of marking to market, that there can be unintended consequences. I learned more about puts or covered call options than I wanted to know, but nonetheless, I can understand the concerns this raises on several fronts. So I want to ask specifically of everybody if, from the perspective of taxpayers who utilize put or covered call options, that they will not just be marked to market, as is our understanding and listening to the committee, and also from outside sources that have come before us, but the underlying stock will be considered to be sold and taxed as ordinary income, even if the taxpayer has not sold it. I believe, Mr. Paul, you got to some of that in your testimony, but if we could, and I'll defer to our academic and start over here and ask all of you to respond.
Thank you, Mr. Larson. I think you're referring to the mixed straddle provisions, and they are amongst the most difficult provisions. The core of many of these questions is the fact that we have legacy laws that are sacrosanct, and that we don't quite know how to meld the old world of the conventional treatment of debt and equity with the new world, potential new world of mark-to-market. And also at the core of that is the Congress's intense concern with straddles, which used to eat up a huge amount of time and Treasury money in the 1970s. And all the time when we're working on these financial provisions, we are concerned about straddles, which taxpayers use to shelter their income. So when you talk about this mixed straddle provision, I think is what you're talking about here, they're struggling to find a solution to...
In our efforts to simplify, do you think that unintended circumstances can result from this that will put the taxpayer at a disadvantage?
Taxpayers are at a disadvantage already under the straddle rules. We always have to ask, is this worse than the baseline? Is it worse than current law? That's the first question we have to ask. Straddle rules are onerous under current law. So I'm going to leave it with that. Thank you.
Mr. Rosenthal?
Well, certainly, Congressman Larson, there will be unintended consequences of a discussion draft. I am optimistic that each of these problems can be addressed. So to take, for example, the problem of qualified calls or the use of puts to hedge a capital asset and investment position. The CAMP proposal, the committee's proposal, addresses the timing issues that arise out of straddles by requiring both instruments, both sides, to be marked. And that's the problem of a straddle. Back in the late 70s, early 80s, there was a lot of straddle activity where losses were recognized ahead of unrecognized gains. So you want to time and match the two offsetting positions in situations in which there's risk management. Mr. Travis earlier described to you a suggestion that you extend the hedging rules to allow derivatives that hedge investment positions to be coupled as a tax hedge so that you can link the timing of the gains and losses. I suggest, in the situation you just described, if we had such a rule, we could take both positions, both the put or the qualified call and the stock, out of the mark-to-market regime, allow them to be exempted as hedges, and match the disposition gains and losses together. And I think we
My
solve the
time has
problem.
run out, but I wonder, Mr. Chairman, if I could get in writing from our...
That would be great if you all could respond in writing to Mr. Larson. That was a bell for us to go vote. We have a witness who's heading south soon. We won't get back in time to hear from her. We've got Mr. Schock, Mr. Young, Mr. Smith on our side, Ms. Sanchez on the other side. So if you could answer the questions as quickly as possible so we can try to get everybody in. Mr. Schock.
Well, actually, ironically, Mr. Larson asked my question.
Oh, boy.
So I would like to use my time to follow up on that. And once again, the formalities, I appreciate you calling this hearing. I hope it's the first of many. And I, too, Mr. Larson, have enjoyed working with you on the financial products issues, but specifically the rough draft that we're going over now. And I specifically am interested in the put-call scenario you had brought up earlier, Mr. Rosenthal. So please continue with your answer.
I've used a lot of minutes. I'd like to share some with my colleagues.
Very nice of you. You get extra points.
But I'm happy. If you like, I don't mean to stand you up here, but I feel guilty that I.
No, you can provide additional information in writing. We'll hear from Mr. Gerlach.
I would agree that using a sort of an expanded hedging approach is a better way to deal with the covered call and the use of puts than marking both positions to market and treating them as ordinary. I also think that as the legislation moves forward, serious consideration needs to be given to the effect of, in effect, marking to market built-in gains on stock positions. That would be a big expansion of the constructive sale rules that Congress enacted back in 1997. And it might be a good or a bad thing, but I don't think it's been given adequate discussion so far.
If you have ideas, please forward them. Mr. Paul?
Well, I would agree that the idea that I don't think the legislation intended to have this consequence on protective put options and covered call writing. I think the drafters were sort of forced to address them given the threshold decision to mark all derivatives to market as ordinary. I think the suggestion that's been floating around of expanding the business hedging rules, which are quite sensible and seek to achieve clear reflection of income, to at least some form of investment hedges, which are currently taxed under the straddle rules and are basically anti-taxpayer, I think that would be a huge step forward if we could do that. It's not easy. All the stuff we're talking about doing is not easy. I think there would be other unintended consequences in terms of valuation of instruments, particularly non-traded instruments, and have concerns that people can, there'll be tax planning at year end to enter into a derivative and then get a valuation that gives you a quick loss and we can get into that in more detail on that if you'd like.
Mr. Travis?
Thank you. I want to echo Ms. Hammer's point that there are unintended consequences of current law, perhaps more than there will be of this, and we may be able to spend our time better working here than trying to perfect current law. I think that's a very good point. Just want to mention one example that we've thought about, not exactly covered calls or puts. Let's take a portfolio of municipal bonds that produce tax-exempt interest. And there may be 1,000, 500, 1,000, there may be a lot of them that you hold in a large fund. And you may be looking at the financial properties of your portfolio overall and thinking about where those bonds in the aggregate position the fund on the interest rate curve. And maybe it's in slightly the wrong spot. And so you want to use a Treasury future contract to adjust where on the interest rate curve all of the bonds in the aggregate are. It would seem that the draft as written would cause you to market the entire portfolio and treat what was tax-exempt income as taxable income. I don't think that's intended. I think it would be addressed by the hedging rule, but I think we would all be happy to work with you identifying situations like this and make sure that they are addressed appropriately going forward.
Okay, thank you.
Mr. Young, you're recognized.
Thank you, Mr. Chairman. I would very quickly like to delve into this issue of the rapidly advancing innovations within financial markets and the seeming slowness of our federal government in responding to these various innovations with respect to taxation. We've heard a few different approaches, and they may be consistent articulated today. Mr. Garlock, you emphasized the importance of focusing on a principle-based as opposed to a rule-based approach. I think that might just be an operating principle as we draft what are essentially rules, laws, to deal with these different things, but sort of ensure that we're not creating all sorts of complicated exceptions here and there, and instead prefer the elegant, simple approach, the principle over sometimes nuance, perhaps. And I'll allow you to clarify if that's inaccurate. Mr. Paul, you've noted that often Treasury lacks sufficient authority to deal with some of these innovations, and I'd be curious as to whether or not you believe that this draft proposal with respect to financial services strikes the right balance in terms of giving Treasury sufficient authority to deal with new innovations in the future. And Ms. Hammer, you indicated that we should basically have more laws, more changes to law more frequently. And by that, I'm curious, were you basically agreeing with Mr. Paul's position, that is, we need to give Treasury more flexibility to respond, or instead, do you think perhaps, for example, we ought to have sunset provisions on some of the things that we're proposing here today so that we can revisit them and institutionalize that revisitation from the outset? So I'll allow each of you to respond. Briefly, please.
Mr. Paul, go ahead.
Yeah.
Quickly, if you may.
Quickly. Well, the draft proposal, at least as I read it, does not really address Treasury authority. It tries to basically deal with the issue by statute in terms of the mark-to-market provision. And I think it would be very robust. It would, in any new product that came in, as long as you could determine it was a derivative as defined, would be under that regime. You might find issues about products and whether they come within the definition or fall outside, and there are a lot of definitional issues. But that would be my quick response.
Mr. Young, I think you did a very good job summarizing my thoughts and even expanding on them. I do think that a bit more authority to Treasury and the IRS to write rules would be helpful. Sometimes I get the response when you go into them that, well, we see your point economically, but we just don't think we have the authority to fix it. So I would support greater authority.
Ms. Hammer?
Mr. Young, again, a wonderful summary. Two things. First of all, Treasury has tons of authority and they never exercise it. So I was at Treasury. We were all equally guilty. Everyone got nervous about making rules because maybe they were wrong, and as I said, just fix them. But nobody wants to do that. So I don't think authority is always the issue, although for character purposes and for mark-to-market happens to be people were worried about that. But I think what you need is some imperative to do something. And I've never thought of the sunsetting provision. It's an excellent idea, but the question is, are you going to do something with it? So I'm very encouraging of you of forcing yourselves to rethink things that are being rethought in the marketplace every hour of every day.
Well, at least if we kick the can down the road under a sunsetting provision, it would be quite transparent that we did so, right? So I yield back.
Thank you. Ms. Sanchez is recognized.
Thank you, and we are in the midst of a vote, so I will ask my question. I don't expect that I'll get to hear answers from all of you, so I would just ask that you please provide an answer in writing. I'm interested in getting your perspectives on the chairman's average cost basis, because some have expressed the opinion that this new proposal will be easier for consumers, brokers, and the industry once it's in place and once there is one method instead of three. But my concern lies in the transition and how that will work specifically, particularly given that there is a grandfather provision for pre-January 1st, 2014 purchases. So I would just appreciate it if, in writing, you all could give your perspectives on the transition. And with that, I will yield back to the chairman.
Thank you, Ms. Sanchez. Thank you all for coming. Mr. Smith was here, who's leading the Financial Services Working Group with Mr. Larson. Sorry he wasn't able to ask you all questions. We look forward to working with you, all of you, throughout this process. Hopefully you'll be back from down south and can come back again, Ms. Hammer. That concludes today's hearing. Please be advised that members may submit written questions to the witnesses. Those questions and the witnesses' answers will be made part of the record. I'd like to thank all of you for your time today as witnesses for hearing. It's been an educational discussion, and I think we as committee members, speaking for both sides of the aisle, look forward to continue to work with you with our goal of having comprehensive tax reform legislation that helps do what you talked about doing today. So thank you all. That concludes today's hearing. Thank you, Mr. Neal.
Thanks, Pat.